I'm Jared Johnson, and on this episode of the Stock Market Playbook, we've got Jason Shapiro with the Crowded Market Report. He talks about his three-step process on how he likes to find extremes in the market, and it's pretty interesting. I think you're going to like this one a lot. Jason's got a lot to say, and he's got a lot of years of experience to back up his thoughts, his ideas, and his process. So enjoy this episode. Take it away, Jason. All right, Jason, thank you for joining us on the podcast today. We are definitely excited to get your take on these markets. Seems like we're in a little bit of a summer lull, one day on, one day off with Iran details. What do we do with all this?
Ignore it.
Don't watch it at all. So you
don't
mentioned
watch it at all about the news with Iran and that. I mean, it's all noise. You know, it's just noise.
Just noise.
What's important in the markets, in my view, is not the news. It's the reaction to the news. How the market reacts to the news is what you want to know. So when I say ignore it, I don't really mean that. Know what the news is. Know what the narrative is for what that news is supposed to do, and then watch what the reaction is. Okay, I think that's the important thing to solving where the market is going. You're never going to know the news in advance, right? Unless you have that direct line to Donald Trump or whatever and what he's going to say next. You know, you're not going to know. So trying to play that game is just stupid, right? But what you can see very clearly is how the markets react to that news, and therefore what phase the market is in and where the good risk reward is.
Yeah. So we're seeing, I mean, obviously, specifically, we see a lot of this, Iran, there's a deal, there's not a deal, and it's just on and off every 2 or 3 days. And the market seems to be reacting less and less to it and caring less and less. We got that big dip a few weeks ago in oil prices, and everything kind of came back down. And then it seems like the reactions seem to be more and more muted. So where do you think that puts us in the phase of at least this current cycle we're seeing?
I think the war phase thing went away a while ago. I stopped even talking about it a bit 2 months ago because I don't really think it even matters anymore, right? Oil stopped going to the upside, even when the war news came out bad. That's when the oil bull market ended. Stocks stopped going down on bad war news. That's when that ended, okay? The April 2nd was a very important day. Up until that point, the war news was essentially, okay, the war is bad, oil's bad, which means inflation's bad, which means bonds are bad, which means stocks are bad. On April 2nd, oil was up 10%, and the stock market went up. So this is what I mean about watching what the market reacts to the news rather than the news, right? At that point, the stock market couldn't go down anymore based on this news. Oil was up 10%. Wow. How did the stock market close up? I'm not here to answer how. I'm just here to say it did. And that is telling you something, right? And that's what I mean by what's the reaction rather than what's the news. That was the low, April 2nd. It gave you the sign, right? So as far as right now goes, what are the signs? I do a daily market close video every day on YouTube. And what I said yesterday was clearly what's been the last, let's call it month to 2 months, is this rotation trade out of the high-flying AI stocks and into the other stuff. We've now seen positioning shift to where people are super long the Dow relative to the NASDAQ, which means, in my view, we're getting ripe for that to switch back to the NASDAQ leading. So now we need the tape to confirm that. Well, one of the things that's been driving this, obviously, is what I've been calling the mothership of the chip trade, which is Korea, right? The Korean market, we know, got pretty crazy. We were seeing some big numbers about the margin that was being used by retail investors in Korea. Got a little crazy. And lo and behold, Korea started coming off and started trading poorly. Um, and with it trading poorly, so did the rest of the chip slash AI trade. Well, yesterday, I thought was a little bit of a market change in tone. Yesterday, we came in, Korea was down another 5% overnight.
Hmm.
And we had bad war news, right? It was like yesterday was a down day. And we saw it opened down, it opened weak. Everything was weak overnight, everything was weak in the morning. Well, by the close, the NASDAQ closed up on the back of Korea being down 5%. On the back of all the things that should get it down, it closed up. It's the first time it's done that um, during this phase. So I think, and what I said in that video was, I think that, and nothing's ever 100%. Sometimes the market gives you a false signal, right? But that was a market tone change. And that could be the first sign that we're about to switch back to the AI stocks going back to leading this whole thing. The rotation being over, and now the AI stocks leading again. And that,
Interesting.
to this point, today at least, has followed through. Whether it follows through for a week or a month, or again, it could all change tomorrow. We watch the tape, we see if that fails, and we make a new decision. I don't predict the future because I think that's stupid. I'm letting the market and the market action tell me, and that switches. Sometimes it continues, and sometimes it switches. So this is what we have to watch for. But again, watching for that yesterday, I thought was an interesting day.
Yeah, yeah. There is plenty of interesting things going on, and before we dive into it further, it's interesting you talk about, you're looking at these correlations. These are all great things to look at. There's some macro in there. There's some reaction in there. There's a little bit of everything. Give us just a little bit. You run the crowded market report. Give us a little bit on your background. How did you kind of get to the spot that you're at right now, and with the focus that you have?
A long and winding road.
So it goes for many of us traders.
Yeah. I started trading in my early 20s. I was living in Hong Kong. It was a bull market, and it sounded kind of cool to me. Everyone around me seemed to be making a ton of money. That sounded kind of cool to me. So I jumped in, just like most people do. That's how most of us start, right? We hear about this bull market. We hear about people making money. Sounds
Yeah,
pretty cool. Just buy some shit and watch it go up and make money, right? And that's what I did. And then, of course, being young and not knowing anything about this, I figured, hey, this is cool. So if I can make $1, why don't I make $2? Or and if I can make two, why don't I make 20? And if I can make 20, why don't I make 1,000? So, levered in, made a bunch of money, bought my Porsche, and then, the bull market ended, and I lost it all. Sold my Porsche, same kind of thing that everybody goes through. But the whole thing intrigued me. I started reading a lot of books about trading, um, and I started taking it pretty seriously. And I spent the next sort of, let's call it 8, 9 years going up and down and up and down and up and down and making mistakes and making a bunch of money and losing a bunch of money and making a bunch of money and losing a bunch of money and really
sure.
getting that nowhere. But I was pretty disciplined about trying to learn. So I went back after 10, now it's 10 years in. Now I'm not 22 anymore. Now I'm 32, right? And it's like, well, what the hell did I just waste 10 years of my life for, right? Um, but I was keeping diaries, being very disciplined about it, as they taught me to do in a lot of these trading books. And I went back and I spent a long time studying that and really trying to break out what has worked, what has not worked, what maybe worked one time but doesn't work over time,
Yeah.
and that slowly became a trading process, which I use to this day. I've used the same exact process now for 26 years. Um, and look, we say that, but even within that, am I staying disciplined to the process? Do I slip? Like there's nothing, I'm not attached to some kind of electrode that if I don't do what I'm supposed to do, it zaps me, and nothing stops me from not being disciplined to the process. But time then teaches you that too. You break process enough times and it costs you money enough times. Eventually, if you are the want to survive, you become more and more and more disciplined, right? somebody asked me yesterday, what do you think your edge is in the market? And I used to get this question a lot when I was raising money for my hedge fund. People would say that. And I would come up with the answer. Oh, well, I use this data that other people aren't looking at, and I use this and that, and blah, 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 blah. But as time has gone on, I realized that that's a bunch of crap. That's not my edge. You know what my edge is? I'm super, super disciplined. Okay. I don't mind sitting here if it takes a year before I put on a trade. Then I'll sit here for a year before I put on a trade. I don't care. That's my edge. And that, quite frankly, is what most people can't do, right? You can come up with systems and processes and all this stuff. Everybody can do that, right? Back tests and all that. Can you be disciplined? Can you be patient? That's the hardest thing to do. As hard as trying to find something that actually works over time is, which is very hard, right? Can you be disciplined? Can you be patient is the hardest thing to do. And, we have this crowded market report now where I have a Discord and people are on there all day and I'm watching them, and we have other people. They don't just trade my process. My thing is not about, hey, here's what I do, copy trade me. It's more about, here's what I do. Here's the discipline. Use it to make your trading better. And people come on there and do all kinds of trading. And I watch them, and they're talking and they're active. And I see it. You know what I mean? The hardest thing for people to do is nothing. They want to trade. The action's there. They want the action.
Yep.
If that's what you want, then that's wonderful. Okay, just know that that's what you want. If what you want is to actually make a living out of this, or to actually make money out of this over time, discipline, patience, those are going to be the two most important things. And God bless you if you can do that without experience. I sure as hell couldn't. It took me a lot of experience and a lot of learning and a lot of mistakes, sometimes which I still make, that got me to the point of that. So anyway, back to that. Once I developed the system, I started trading it, and I slowly started. I started like a little fund, friends and family, and put up some returns. And I couldn't really grow that very much because trying to raise institutional capital is very hard. So I kept working. I worked at a prop desk, and I worked at a hedge fund. And then once I worked at a big hedge fund, and I really established a good long-term track record with a lot of money under management, I was legit at that point. And it took me, I was already 45 years old at that point.
Yeah.
Once I did that, then I was able to go out and play the game, go out and raise money from people on my own, from institutions, and be taken seriously. And that's where I'm at. First, I started sort of a big fund. I wanted to be a big shot. I ran that for about 4 or 5 years. I didn't like it at all. I didn't like the pressure of needing to raise money all the time. I didn't like having people working for me and being responsible for them. That just isn't my thing. So I cut that down, and now I'm a one-man operation. I earn a good amount of money, but I do it for clients who have been my clients for a long time. I no longer raise money. I no longer take new money in. I don't need to. I'm very happy with my clients. I'm very happy with the assets that I manage. I'm very happy with the income that it provides me and the lifestyle it provides me. And I'm good. So that's kind of where I'm. So, and that's how we got into the crowded market report. It was, Jack Schwager put me in his Market Wizards book. I started getting a lot of people contacting me from that, asking me if I could help them, which I would like to do at this point. There's a story that I tell that had a big effect on me. I once met Paul Tudor Jones when I was a younger person in my late 20s. He was at a
Sure.
conference. He was at a conference I was at. I went over to him, being the young, cocky kid that I was, shook his hand and told him, "Hey, Paul, I'm coming after you." And his answer to me was, "That's great, but when you get there, give back." Right. And I didn't even understand what that meant at 28 years old. Right. But I
Sure.
understand now. You get older, you get into a point, it's like the whole pay it forward thing. Right. People have helped me along the way that didn't need to help me. So I would like to help people, and
No, that's
pass
great.
along. As a legacy thing, you kind of want to pass along. Hopefully, the stuff that I have learned and the stuff that I developed can last longer than me. So you pass it along. So we start, these people were asking me for help, and I didn't really know how to do it. I kept telling people, like, I'd love to help you, but I've had 300 people ask me in the last month. I don't know how I can help 300 people at the same time. I have a business to run, I have a family. And
Yeah.
one guy was like, well, why don't I start a web page? And you could centralize that, and you could do this. And he did that. And that's what became the Crowded Market Report. So those are the two things I do now. I continue to run my fund, and we do this Crowded Market Report thing.
That's great. That's great. I want to talk more about the crowded market report, but before we do, let's dig in a little bit more to your process.
Yeah.
I mean, what are kind of your top, if you had to, and I don't know, maybe you have more, maybe you have less, but what are your top kind of two or three things that you look at the most to determine if there's a trade you want to take, or what are
It's
your
very simple.
metrics?
It's actually very
Yeah.
simple. Three things that I need for a trade, right? Positioning. So I want to be looking to get long things that everybody's short. Think of GameStop. Why did GameStop go up? Because the company got better? Because the fundamentals changed? No, because there was a massive amount of shorts in there. And when it started to go up, they all got squeezed. Period. The end. That's the only reason it happened. Okay. LTCM, if you remember that,
Yeah.
went broke. They went broke on a trade that was 100% correct, right? Why did they go broke? Because some other thing went wrong. They had to get out of that. They couldn't get out of it, so they had to raise margin. The only way they could raise margin was get out of this other big European trade they were in. A lot of other people were also in that trade. There was nobody to take the other side because they were all too leveraged. So they got out, they went broke on a trade that ended up being 100% correct. Had nothing to do with the fundamental, it had to do with the positioning. There were too many people in the trade. So when something else happened over here that made them need to get out over here, they couldn't get out because it was too crowded. So I'm always looking to get on the other side of massive crowdedness. Everybody's super short, I'm looking to get long. Everybody's super long, I'm looking to get short. And we can get into how I measure that in a second, but that's rule one. To go along with that is rule two, the sentiment and the narrative. I want to know what the sentiment and the narrative is. Why is everybody so short? Why is everybody so long? Right? Oh, everybody is short because the interest rates are going up, or everybody's long, whatever it is. I want to pay attention to that, right? Um, and the reason I want to pay attention to that is because of number three, which is market action, like we talked about. Why is everyone so getting short here? Well, because there's a war in Iran, and that's causing oil prices to go up, which is causing inflation expectations to go up, which is causing interest rates to go up, which is causing the stock market to go down. There's the narrative, right? So now I know when the market action, as we talked about earlier, goes against that. Okay. Now, here's oil up 10%. Well, based on that narrative, oil up 10% means bonds should be getting killed. Are they? Yes. Okay. Well, bonds getting killed means that stocks should be getting killed. Are they? No. Stocks are up. So the market is now saying that narrative is being broken. So first of all, everybody's mega short. Second of all, I know why they're mega short, the narrative. And third of all, the market is now going against the narrative. That's when I put on a trade. The market is now confirming for me that it's time to get long because everyone's short. I'm not just going to get long because everyone's short. Okay, that can last for a long time. That can run you over. They can always get more short. They can keep going down more. I'm not just going to get in the way of that. That's stage one. Stage two is how does the market confirm it? And they confirm it by the market going against what the narrative says it should be doing. And that's when I put on a trade.
So let's go to step one then. What are your go-tos for measuring, these crowded trades, right? Too long, too short. How do
Right.
you look into that?
So as a futures trader, what I was led to is the Commitments of Traders report, which is something the CFTC puts out every week that shows where people that trade futures are positioned in the market. It breaks it down into three groups. Commercials, who are like farmers, is a commercial, right? Anyone who actually has underlying use of the product. And they get to call themselves commercials on their account opening forms, which allows them much reduced margin since they have the underlying behind it. So they want to be called a commercial because they save a lot of money, right? And then everybody else, it's not a commercial, it's a speculator, me, you, hedge funds, whoever else, right? And those are broken down to two groups because if you go over a certain amount of contracts, you have to report it. And they do that because they don't want anybody to, corner the market like the Hunt brothers tried to do in silver back in the 70s, right? So the people that have to report their position sizes are called large speculators. The CFTC calls them reportables. I call them large speculators. Okay. And then the rest, everybody else, people that are 5 lotting, 10 lotting, 20 lotting, right? Most people are fall into the third category, which is small speculators or non-reportables. So I look at those, and at extremes, that's what I'm looking for. I'm looking for both the large and the small speculators to be extremely long, which would make the commercials extremely short. And that's when I'm looking to go short. I'm essentially going with, let's call it the smart money, because the farmers who know more about grains than anybody, right? And against the speculative money. Now, that doesn't work all the time. You would think, oh, well, if it's a smart money, then why not do it all the time? Why only in at extremes? It doesn't work all the time because as a hedger, if I'm a farmer and I'm hedging my output, that hedge is not free. There's a cost to hedging, right? And what a speculator is doing is taking the other side, offering that liquidity to those hedgers, but needing to get paid to offer them that liquidity. It's pretty simple, right? Why would they ever do it if they weren't going to get paid to do it? Which is why over time, people like trend followers make money. They're essentially getting paid to give the hedgers an ability to hedge, to reduce their risk. You're not reducing risk without paying for it, okay, over time. Right?
Sure.
So you don't do this all the time. But at extremes, what my studies have found is at extremes when the speculators get mega, mega, mega long, and it's, or that's when the markets turn, right? So I see it as the discounting mechanism in the market is not necessarily price. I believe it's positioning. So it's not, hey, this asset has gone up a lot, therefore it's a sell. For me, it's, hey, everybody in the world is already long this asset, so therefore it's a sell. That's how I approach that, right? That's how I look at it. And if you think about it from a very extreme level, which could never happen, but just to make the point, if everybody in the world had every single dollar that they had long some asset, that asset could never go up, no matter what the news was, no matter what happened, because there's no more money to go into it, period, right? It's an extreme example, but just to make the point, right? I'm looking at that on a relative basis. So, okay, everyone is long this thing already. It can't go up anymore. Okay, but how do you know that more people can't get long? Well, the news comes out that's bullish, that meets the narrative that all the bulls have wanted, and the market doesn't go up on that. Well, now that's telling me, okay, you're right. All the money is in there. There's no more money left to go in there. The market is telling you that. So that's where I get short. Does it work every time? No, but it gives me a few good things.
So on that, I mean, what's a go-to scenario there? So let's say something's bullish, and you see some extreme sentiment in the COT, in the Commitment of Traders report, and you, I mean, are you looking, let's just say, for example, for an earnings report, right? Very positive earnings report, stock doesn't go higher. We've seen that happen quite a bit in some of the AI stocks. Chip stocks have been going, bonkers on some of that. But an earnings report's kind of an easy, low-hanging fruit. So you see a positive earnings, doesn't go higher. Is that a signal for you?
If I were trading individual stocks, absolutely. Absolutely. It gets a little tricky nowadays, especially with the stocks that are being very highly watched. But you certainly had that the other night in Samsung. Samsung came out with earnings. Samsung is obviously a mothership stock here, right? Had great earnings. Nobody argued that they were great. Not only were they great, they were better than expectations. Everything was just blowout, and the stock went down. And it hasn't gone up since. Now, it gets a little difficult here because a lot of people are looking for that stuff nowadays. We hear a lot about it nowadays. We've seen it on NVIDIA a number of times over the last few years where NVIDIA earnings came out, the market, it went up, it failed, it closed down, and that was the top for NVIDIA for a while. But a few weeks or months later, it ended up taking out new highs, right? But yes, the short answer is yes. That is certainly a good. Listen, here was a great one. Home Depot a few weeks back. I like to go where people aren't looking because I find that's where the best returns are, right? Home Depot, which no one's looking at anymore. No one cares about stocks like Home Depot anymore. If you
Sure.
don't make chips, then who cares? Well, Home Depot came out with pretty crappy earnings a few weeks back. All right. Stock gapped down. It's been in a downtrend. It made new lows that day and it closed up on the debt for absolutely no reason. That was the bottom of the stock.
So you mentioned earlier individual names. Are you trading the indexes more, or do you take some individual
I trade
positions?
all futures. I trade all futures. So stock
Okay.
indices, bonds, currencies, and all the commodities. I trade across 37 different futures markets. The same exact process across 37 different futures markets. I don't get a lot of trades. I'm trading major market turns. How often does that happen? If I'm lucky, twice a year in a market, you know? So I spread. It's like, I feel like I'm counting cards at the casino, but I'm
Sure.
doing it like, it's like they do it. I have 20 different tables that I'm watching. And when the card count gets hot at one of those tables, I go to that table and that's where I play, right? Rather than force it on the one table that I can play at, I'm at personally at 37 different tables. And when the card count gets hot there, the COT gets hot, the whole thing gets hot. That's where I start to play.
So are you trading all categories in the futures markets? Are you going with grain and
Yes.
energy
As
and
long as there's
any?
liquid, as long as there's liquidity, yes. I can't trade the things like orange juice anymore because there's no liquidity, right? But other than that, yes. Stock indices, fixed income, currencies, grains, energies, softs. I'll do like coffee, cotton, things like that. All those things. Just not orange juice. Is I've become a dinosaur in orange juice. Um, Even the meats, you know. And you got to understand. I always say this to people. I'm from New Jersey, man. You know what I mean? I've never been on a farm in my life. I don't know anything about these things, but you don't need to, right? Here's what I know. Everybody is mega short wheat right here. So I'm looking to get long. I start paying attention to wheat. Just go on the internet. It's very simple, right? What's been driving the wheat market? Why is it going down? Why is everybody getting bearish? Why is everybody getting short? Okay. The harvest is expected to be high, let's say. That's why everyone's selling it. Okay. Well, and then the news comes out. Here's the harvest numbers. Higher than expected, more bearish than expected. Wheat goes down, closes the day up. Boom, I'm long. It's that simple, right? And I've made money on these markets that like I say, I can talk a pretty good game on the financial stuff, stocks, bonds, currencies, because I did go to school, for finance, and I've read a lot of books about economics and all. I can talk a pretty good game about this stuff, but you really want me to talk a good game about coffee? Come on, I don't know the first thing about it, but it doesn't matter. I've made money trading those things over time by just following my process.
That's interesting. My last guest right before you on the podcast is a grains trader. She just trades grains and does some of the wholesale side of it as well as a bit of a broker with the actual farmers and so on.
Hmm?
And it's interesting to hear how much detail that process was just in the grain side of things. And so it's interesting to hear that you're going to all corners of the futures markets, and your process is robust enough to keep you on the right side of some of those big moves. So that's super
If
that's
you're
super
if
cool.
you're if you're trading against the crowd and you're not doing it until the market confirms, right? Until the market action is right, you could trade anything. It doesn't make it. Those things, at the very least, are going to keep you out of trouble, which is the first step in this. I always say with trading, you have to stay alive long enough to get lucky. That, that,
That's true.
that's step one, and those things will keep you there, right? In particular, the tape thing. I tell people all the time, I really don't care what makes you want to get long or short something. The COT data, that's what I use. Okay, great. I don't care if it's because you think Donald Trump is great or Donald Trump's a jerk or you think that there's going to be El Nino this year, and that's going to be bullish for grains, or you think El Nino is a bunch of crap, and that's going to be bearish. I don't care what the reason is. God bless you for doing your analysis and believing in your analysis. Just don't do anything until the market confirms what you're saying is right. Don't fight the tape. That's going to keep you out of trouble. And know where you're wrong and respect where you're wrong and stop out when you're wrong. I don't care. Here's a Head and Shoulders. I want to get short because this thing is showing a Head and Shoulders. And I'm not a technical analysis. I don't trade based on this, but maybe you do. Good. You're shorting this because there's a Head and Shoulders. Great. Do it. But when there's rules for Head and Shoulders, this is where the Head and Shoulders is no longer valid. Okay. That's where I'm wrong. That's where I take my loss. If I got in because it's a Head and Shoulders and the Head and Shoulders fails, then I have to get out. You know, if you do that, you will survive. And eventually your Head and Shoulders will hit, or your fundamental analysis will, and you'll make a lot of money. That's what this game is. You know, it's not about predicting the future because we can't do that. It's about getting into trades that offer asymmetric return to risk. That's it. Lose a dollar, make 8. Lose a dollar, make 5. Lose a dollar, make 4. Lose it. That's what this game is. Period. That's all this is. It's not about the rest of this bullshit that they want to put us on TV and talk to us about this story and that story and the other story and who's going to know more about where AI is going. Nobody knows the future. Nostradamus is not a true story. Okay. It's fascinating. Okay. It's fascinating and it's fun, but it's not true. There's never been a person that knows the future. I don't care who you are. And it's even harder with the markets because it's a discounting mechanism, right? Like I can say the sun's going to come up tomorrow. Okay, I don't know that, but there's a pretty high probability that the sun's going to come up tomorrow. But who's going to take the other side of the bet? I'm going to have to pay, 10 million to 1 to get somebody to bet. So it's not worth the risk reward. And it's the same thing in the market. You can sit here and say AI is going to take over the world in 5 years, and you might be 100% right, but that's not the question. The question is it discounted into the market? That's the question, right? I say it like we're betting on football. Here's the greatest team in the NFL playing the worst team in the NFL. It's pretty easy to say the greatest team is going to win, but that's not the question. The question is, are they going to beat the point spread? That's what you have to know. And that point spread, you better believe it, is the discounting mechanism that everybody knows that this is the greatest team and this is the worst team. And they know the statistics of how many times this team wins at home on grass on a Thursday night against a team that blah, 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 blah. All those things are so well known that the discounting mechanism is that's what you're betting against, right? And it's the same thing in the market. You think you're going to outthink the market? The market is every single person in the world, essentially, that's involved in this, which is in the millions and millions and millions, all of their knowledge combined into the current price. You're going to outthink that? Good luck.
So speaking of the outthinking the market, has any of these technological advances been incorporated into your strategy, into your process? Are you using any AI, any of this technology to facilitate research, to watch things?
It makes it a lot easier to start to develop what is the narrative. I mean, I can get right on ChatGPT. Look, I'm listening all day and I'm reading all day and I'm paying attention all day anyway. So I kind of know what the narrative is, especially like I say for the major markets everybody's talking about. But what's their narrative right now for coffee? They ain't talking about that on Bloomberg TV. Okay. But I can easily get on ChatGPT now and say, hey, man, what's going on in the coffee market? What's driving coffee these days? Right. And just like anything with ChatGPT, if you've used it enough, it's good. But at the same time, it can also lead you astray. So, you have to ask it in a few different ways. You have to give a few different prompts. And the more you use this, the more you get used to it. Right. But it's easy for me to start to try. It's easier for me to start to try and figure that out. How about, what are the news? What's the news flow this week in the coffee market that's going to drive the coffee market? And I can ask ChatGPT and I can ask Claude and I can ask it in a few different ways and I can start to develop a decent, it doesn't, like I say, it doesn't have to be that complicated. Hey, there's a big coffee inventory report coming out Wednesday at noon. Okay, thank you. That's what I need to know, right?
Sure.
So that has become a lot easier thanks to AI. Yeah.
Yeah, yeah, that does seem to be the case with so many traders, myself certainly included. There's a lot of tedious tasks involved in the research process, and AI certainly makes that a lot easier. So to make sure we have kind of a good and my listeners have a clear picture. So you're looking for extremes and you measure that through a couple of different things. But to kind of confirm your extremes, you want to see that there's a narrative that's either being ignored or still abided by, so to speak, and then you want to see that price action to kind of confirm everything. Is that a little bit of those three topics we covered?
Looking for extremes in positioning, understanding what the narrative is for why people are so extremely positioned, and then watching for the market to screw them. Watching, letting the news flow give them everything they want, and then the market not to abide.
And it's
And
still not good enough.
the question is like, why didn't the market go down on that? And my answer is because everybody's already short, right? And again, look, here, I'll give you one more example. The low of the bear market in stocks in 2022. I assume everybody's probably old enough to remember that market. It was only a few years ago, right? We went
Even
down
I
all
am. Jeez.
we went down in 2022 pretty hard. Why were we going down in 2022? Inflation expectations changed, right? Inflation started coming in heavy. The Fed started raising rates. So inflation numbers would come in high, Fed would raise rates, stocks would go down. That was what was going on all year, right? Then October came. The CPI number came out in October, comes out every month. It's the major, or at least one of the major inflation numbers. CPI came out in October. It was higher than expected. It was also the highest CPI number that had come out during this whole cycle. So this was clearly bad news. Higher than expected. CPI, the expectations were already high. People were already freaking out about inflation. Came out in worse than expected. So it's even more inflationary than expected. Bonds went down. Stock market opened down hard and then closed up on the day for no reason. Why did it do that? Guess what? That was the exact day low of this entire bear market. We have not seen those lows since that day in October of 2022. That's what it looks like. That's what I'm looking for.
That's a great that's a great example, and that's also a great illustration of the patience game, right? And waiting until those moments happen. Those extremes can be few and far between, but can have massive runs attached to them.
The risk
So
reward
that's
ends up being great. And listen, it not only gives me that, it gives me a great place, more importantly, for my risk management stuff. Because, okay, let's say I buy that October day, right? I buy the close. It closed up. I'm buying the close. The low of that day should never be seen, in my view. If I have this trade right, that low should never be seen again, right? Here's somebody who came in. The market had been going down now for 10 months, going down hard. People freaking out, people getting short. The CPI number comes out worse than expected. Somebody sells there. Should that person ever make money? They're essentially taking no risk. They waited for all of this stuff and now they're getting short. Like, that person should never make money. We've all been on the other side of that trade, okay? We know what it looks like to lose on that, as do I. This is how I learned most of this stuff, is by studying the things that I lost on. How can I do we've all been there. If I just do the opposite of everything that I'm doing, then I'd be making money, right? Well, I've kind of
sure.
taken that to the extreme, right? So I'm doing the opposite of what that person is doing. That person should never make money. And if that person does make money, i.e., if the market goes and takes out that low, well, then clearly the trend is incredibly strong and I don't want to be fighting it. So I'm wrong. So I stop out. So I know where my stop is. It's a stop. It's not just like some kind of money management stop. If the market moves X against me, it's a stop on the chart that actually makes sense, right? So there's my stop. I know where it is. I know where my entry is. I know how much I'm risking on that trade. I know how much I want to risk of my portfolio on each trade. So there it is. I know my entry. I know my stop. I know how to size it. That's it. I'm gone. I'm either going to get stopped or I'm going to make money. And then I get out for the same reasons I got in. I got in because everybody was super crowded short. Well, when the data now shows that they're no longer super crowded short and that goes neutral, well, then I get out. That's it. I don't have to decide on, oh, should I get out here? Is it enough profit? Should I trail my stop? Should I this, the bop, a boop, a beep, a bop, all these random things, right? I got in because they were super short. I'm getting out because they are no longer super short. And does that mean that I get the top? No, sometimes the market keeps going up, but I'm not worried about that, right? Because it has nothing to do with my process. My process is they're super short. I want to be long. If it works, they're no longer super short. My edge is over. I'm out. That's it. Next.
That's great. That's great. Well, tell people where they can find out a little bit more about you. You've got the Crowded Market Report. Is that your go-to spot? Tell everyone where they can keep an eye on you and your process.
Yeah, crowdedmarketreport.com is our main webpage. We post some things on Twitter. We do a lot of stuff on YouTube and a lot of free stuff on YouTube. Every week, we try very hard every week to have a relevant video on YouTube for free. Whether it's me talking about something, whether it's me going through something I can point to as an example that happened this week, a live example of what I'm talking about, right? Or I'll do an interview. Sometimes we bring people on that are not what I do. We'll bring on day traders. We'll bring on different people that offer different viewpoint. Because I was in Jack's book, it got me some form of legitimacy. So I'm able to get people to talk to me. Okay. So we try to bring people on, that people request on our Discord. Hey man, can you get this guy? Can you get Cam Carson or whoever? Can you get? And most of these people I don't know. I've not spent a lot of time in my life paying attention to who these people are. I was never even on social media but people suggest us and we go out and we try to get them. So we do interviews with people. I'll do these lesson videos sometimes. Sometimes I'll just get on there and rant about how stupid people are and how fake people are and what to look for. What to look for with a bunch of bullshitters. There's obviously, a lot of people on our Discord have come from other Discords where they felt that they were robbed and ripped off, and they show us examples of that. So sometimes I go on there and I say, look, this is from the experiences of other people. These are the things to look out for when it comes to these scammers that are trying to. And look, do we charge for our thing? Yes, we do. Okay. It takes money to run one of these things, but there are a lot of people out there, as we all know, that are shills, right? So I try to sometimes say, hey, this is what to look for with the shills. Do what you want to do, but from my point of view, this is what a shill looks like, right? The first thing I say are things like someone who claims that their win percentage is 80, 90%. That's a shill, okay? Win percentage, first of all, means nothing. My win percentage is less than 40%. I haven't had a down year in 25 years. Audited returns, okay? So that's the first shill, right? The second shill to me is anybody who tells you they know where the market is going, okay? It's bullshit. Nobody knows. It's not about that. Focus on people that talk about risk reward. Focus on people that talk about asymmetric opportunities. That's what this is about. So anyway, I do videos like that, all kinds of different stuff. Again, sometimes people say, hey, Jason, can you make a video about this? And I'll try to do that, right? So every week we try to have some value added video on there. And then we also do a daily market close. Once a week. It's public. And the rest of the days is for members. But
That's great.
That's all on the webpage. There's all kinds of different memberships. We create COT charts, which you can get for free on the internet, COT charts. We create ones that I think are a lot better. They're more interactive. You can change a whole bunch of stuff and be interactive with it. There's a service that just gets the charts. There's a service that gets you all this stuff, my weekly newsletter, and there's all kinds of different stuff. But you can go on there and check it out. And if nothing else, there's plenty of free stuff on YouTube that you can check out that we'd love to have you see.
That's great. That's great. We'll post the links to all of those with this episode and make sure everyone knows how to find you and get a hold of you. But Jason, thank you. That was great stuff. Thanks for being on the podcast, and we will keep track of how things go, and hopefully we can have you on again in the future.
Absolutely, man. Great talking to you.
Thanks again.